Right, here we go, guys. Let's just go through the disclosure really, really quickly. Information and opinions in this webinar, they're for general information use only, and they're not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in this webinar are subject to change without notice, and the report has been prepared without regard to specific investment objectives, financial situation and needs of any particular recipient. Foreign exchange and other leverage products, they involve significant risks of loss, and they're not suitable for all investors. Increasing your leverage increases your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act. And contracts for different source CFDs, they're not available for US residents due to regulatory reasons. So let's just hopefully taken a good look at that, and I'm just going to put back up my chart. Let me move that over here. I'm going to put up cable, very short-term chart, because I want to show you guys this, which is the impact of inflation data. We've now gone through 159. It was kind of an excuse to sell sterling, we thought. 158.40 is very good support. This is just a 30-minute chart, very, very short term, and the reason for this sharp drop really is the news on inflation. So inflation fell as expected to 2.7%. There were pockets of weakness, but overall it was in line. So so I asked you guys questions. Pan, you said that the Fed meeting should be bullish for the dollar. Likewise, there's a good few. James Bond is a complete bear. Rocco, you make a good point, actually. You've cleared all positions, so it could be a bit of a joyride. Pittman is going with the flow. It's always good to go with the flow. What is the flow, James Bond? Well, the flow is kind of it's difficult, right, in foreign exchange, because there tends to not be because there's no exchange. So basically the flow is just, where the majority are going. Are we going higher or are we going lower? And jumping on the back of that. And I'll show you, I'll walk you through some strategies to kind of go with the flow, go with the with the overall momentum in the market. That's another way of talking about it, is overall momentum. So there's a few ways now that we're talking about this. Pittman, yes, lack of direction at the moment for sure, as one would expect. I was talking to some colleagues here, and we've been looking at different things over the last few days, and the one thing that I would say is this is the most important meeting, probably not just of the month, probably but of the year, for the Federal Reserve. This is where they could potentially make that decision, implement that decision to taper. But for us, we don't think it's actually just the tapering instructions that have such a big impact. We also think it's whether or not they are really taking the first steps to pull back on QE, and that's far more important for the long-term direction of the market. Because remember, market prices things in 6 months in advance. So essentially, the tapering, if they do decide to taper tomorrow, that's already been priced in. I'll show you some examples of why we think that's already been priced in. But it's all about, their forward guidance. Remember, they are also releasing, also releasing interest rate and economic projections tomorrow as well, at exactly the same time as Bernanke starts talking. So everything, we get just the big data dump really at 2 o'clock. 2 o'clock London, 2 o'clock Eastern time, US time, 7 p.m. UK time. So this is just going back to cable. Cable is really as good as anything to discuss whether or not to take a look at what's been going on in the market. As you can see here, there was a huge gap on Sunday night, and that is because we saw prices. So they closed here on Friday, and then they opened here on Sunday, and it was that news about Summers withdrawing from the Fed race. This is a really interesting chart because it does show, this is an hourly chart, by the way, it does show you the impact that news can have on the market, weekend news can have on the market, and that is huge. I mean, that is a massive jump up. If you've been short of sterling, you were hurt badly. And that's one of the reasons why we wouldn't really recommend, certainly not our clients anyway, keeping open positions over the weekend, over long stretches of time, potentially when the market's closed, when anything could happen. No one could predict that. you didn't know, no one knew what was going on. So this is a lesson, right? Maybe a lesson, hopefully not a lesson learned for some of you, but it might be. But anyway, what we've seen here is we rose to a high of 159.60, highest level in 9 months, back to January highs. Since then, we fell off quite sharply yesterday as the dollar got its groove back. There wasn't too much driving that from a pound perspective. Today, we just made a bit of a pathetic recovery and then fell back sharply. It fell back fairly sharply, kind of dropped 30, 40 pips really on the back of inflation being in line with expectations and falling. The reason why, obviously, is that it kind of makes gives the Bank of England some wiggle room. But it's interesting when you see gaps like this. Often these gaps, the market will look for them to be filled again before it takes another long position. So this kind of the market sees as a bit of a potentially overreaction. We could get back to these lows, which kind of come in about 158.70. I did also mention that 158.40 is a big level. I'll show you why now. Just bear with me. Here we go. The reason why it's also important here is that it's the base of that daily Ichimoku cloud comes in at 158.40. That's an important level. And roughly, it's a few pips away, but I think before people will think about going back long sterling, they're going to want to completely fill these gaps. So there could be a bit of a sharper drop in the pound. So we had lots of gaps in the market of late on a number of pairs. Indeed, we did have, that's a very astute observation there. There were gaps in most of the dollar crosses actually on Sunday because of that news from the Fed. So as I mentioned in the pound, we had very similar ones in the Aussie, for example. I can show you now actually. Euro and plenty as you say, plenty of that huge gap there in the Aussie. The Aussie was a real beneficiary because remember the risky end of the FX spectrum, like the commodity currencies, like the Aussie, like the Kiwi, they are considered to be the big beneficiaries if the Fed isn't as or doesn't have such a tightening bias as expected. So that's a key thing. Interesting gaps in Euro Sterling and Aussie Kiwi, Peter. Indeed, that is right. This is Aussie Kiwi. There was an interesting gap actually that was before, but let's take a look at Aussie Kiwi actually because we saw a bit of another decline lower. I want to show you just the daily chart because as you can see, last week, actually I think it was last week that we put out our trade recommendation to go short Aussie Kiwi. It was a market idea, sorry. As you can see, we said around about that 116 level, and indeed we were spot on actually because we did drop lower. And this, as you can see, this kind of 112, just above 112 level here, which would be the low from the 1st of August. That's a level to watch out for. So again, we're in a range. We're looking pretty weak in that range right now. And Aussie Kiwi kind of getting hit quite hard on the back of some weak data relative to some strong data coming out of New Zealand. Likewise, the fundamental reasons to go short Aussie Kiwi are also to do with the RBA being in fairly neutral to bias easing mode, compared to the Kiwi, which is neutral to a tightening bias, which have a kind of neutral to tightening bias at the moment. So that's also Kiwi positive. So as you can see, big drops here since April. But we did see kind of a shoot higher yesterday in the Aussie. And as I said, it's like, the Aussie really was one of the chief beneficiaries of, what was going on with the summer's news. So that was it really did well on the back of that. Now I also want to just go quickly to dollar yen because I know that some of you for most people, right, when you look at when you look at Fed meetings, it can be quite, especially kind of such an important Fed meeting, it can be really a little bit stressful for traders, retail traders in particular, but all traders generally. Don't think that a guy just because they work for a big institution is having a more easier time than you. They're not. Trading is still all about the big idea. Even if you would use an algo, you've still, the code behind that algo is still about an idea or a way to look at the market. And the trouble is with big things like Fed meetings, that's why sometimes it can be easier to use kind of, your strategy centers, like we have one at forex.com, pure, just kind of more automatic way of trading, purely because a lot of things can happen at once. So what you can see, what is quite useful, or what is quite useful, I think, if you're not using that, if you are using your doing it yourself, then my advice to you is to focus on what you're going to be looking at. Focus on one, maybe two things. I even think two is too much. When you look at, when you think of the Fed, they can have such a huge impact on the market. So you've really got to got to focus your attentions on one thing, because it's going to be volatile. It could be very whipsaw action tomorrow. I mean, John Hilsenrath, he's a writer, he's the Fed watcher at the Wall Street Journal. He's generally thought to have quite a lot of influence, quite a good ear to the Fed, be quite close to Bernanke and co. He wrote an article yesterday, and his overall view, and I will just read it out to you, is that the tapering decision will be a close call on whether to start pulling back on QE. The other point that he made was that the Fed is changing its emphasis from bond buying to having a low rates pledge. And essentially what that means basically is that the Fed could start tapering asset purchases, but it could also, so as much as it starts tapering asset purchases, it could also start just reinforcing the fact that it is willing to keep interest rates low for the long term. So you've got to balance that. So on one hand, they're being, potentially hawkish. On the other hand, they're being particularly dovish. So it's kind of an interesting, interesting dichotomy there. Rocco, unfortunately, I don't have the link, but if you just type it into Google, just go Wall Street Journal Hilsenrath, or go onto the Wall Street Journal website. I know that it has a paywall though, guys, so if you're not members, you probably won't be able to get it. But if you put it into Google News or something like that, you might be able to get it. And I'm sure a lot of people will be writing about it. So, for me, in that environment, I tend to look at, dollar yen, because dollar yen has got a huge correlation with what's been going on with treasury yields. So let's just put that, I'll just chart that. I know some of you have joined me before, may be interested to see where this is going. But basically, for a strategy for a Fed meeting, I'd say look at one pair unless you're going automatic, in which case make sure that you've, set up all your parameters. Just bear with me 1 minute. I'll just do this. Just put this chart together for you. Here we go. Let's take a look at this here. This is dollar yen and the spread between 10-year US and 10-year Japanese interest rates. So the red line is the spread between the rates and the white line is dollar yen. And as you can see, they follow each other fairly closely. There have been periods where they haven't followed each other as closely, like here, for example. Dollar yen peaked, but yet the spread dipped. But then overall, basically since kind of June, since the beginning of the summer, we've again trended up, both trended fairly closely together. As you can see as well, we reached a high last week in dollar yen and in that rate spread. Since then, the rate spread has been narrowing, so that means that US yields have been falling at a faster pace than Japanese yields. We did see that, obviously on the back of that news about Larry Summers, and that's weighed quite heavily on dollar yen. But it's not, obviously the trend is still in place, right? So the uptrend is still in place for the rate spread, which should be positive for dollar yen. However, we are going to have to wait for that Fed meeting. If that Fed meeting causes this rate spread to go and widen again, currently it's at 2.1%. If it does widen further, then that could help drag dollar yen back above that 100-day moving average. Now let's just go do a bit of a deep dive into dollar yen right now, what it's doing. And I want to show you this daily chart, because these levels have been huge. That's the 100 and the 50-day moving average. That is a really important cushion of support right there. That lies between 98.70 and 99.05. Very key level. Haven't really gone below there. As you can see, there have been some long shadows, but we haven't really gone below there since the very beginning of this month. which makes this 70 to 99 level a very important level of support, which has attracted some buying interest. So, if the Federal Reserve does manage to taper, does taper, but doesn't really do anything that's going to shock the market, then we think that downside is protected at 98.80. One thing that we would expect is a lot of whipsaw actions. What we may see are very long shadows on the candlestick charts. On Thursday morning, come in and take a look at your candlestick chart, because I could well imagine that we get a long candle down and a long candle up, and that's what whipsaw action looks like. This, for example, is the 6th of September. Anyone remember what happened on the 6th of September when we got this other long, particularly long wick on the candle? You can write it in the chat box if you remember what happened on the 6th of September. I know it was a while ago now. Syria, it wasn't, even though that was kind of going on, but what it was payrolls, US non-farm payrolls. That's another key, driver of the markets. Often ends up in whipsaw action, and I see the Fed meeting ending up whipsaw as well, because I think Hilton Rath, has a very good ear to the market. I think he knows what to expect, and there's, two things take from that. They're not going to be overly hawkish, no way. Even if they do start to taper, they're going to emphasize the fact that interest rates will be low for the long term. Now, the risk that the Fed is taking is that forward guidance policy hasn't really worked for the hasn't really worked for the Bank of England. And the reason why is that if their own forecast suggests that the economy is going to pick up, then people may think that actually they won't keep rates on hold or keep them low, not on hold, but keep them low until 2016, because by then, the economy is going to be in full employment. So it's an even more difficult thing to try and digest. And I actually think we could see very whipsaw reaction in the aftermath of this data. And then we're going to see the trends emerge. So the market's going to want to digest all of that information. They're going to be looking for three things. Have they tapered? Have they given forward guidance on tapering? The other thing that they're going to look at is have they revised up their economic forecast? Have they revised up their interest rate forecast? A very kind of hawkish development, or a development whereby the market may challenge the Fed's forward guidance that they keep rates low, which could have an upward impact on the dollar, upward impact on treasury yields, is if they revise up their economic guidance, but they don't bring forward their expectation for rate hikes. Now, if they bring forward their expectation for rate hikes, expect the dollar to move higher, expect treasury yields to move higher. So there's a lot to take in there, guys, and I know some of you probably are like, what is she going on about? My advice to you is to follow us on Twitter on forex.com. Also follow our researchers on the forex.com page. We're going to be dissecting all of this and making it very easy for you guys to understand. So that's the key thing there. Now, I could bore you to tears, but basically, just in terms of where the range is, you can pretty much see it here, right? This is the top, 108.50. This is the bottom here at 98.60. If we get back to kind of that 98.60 level, it's likely to attract some buying interest. In fact, we only had a dip below 99 yesterday for it to attract some buying interest. But as you can see here, what a tiny little candle that we've made so far today. I would expect it to end up like that. Now, we do have CPI data later today. What is the market expecting for CPI? Let's take a look at our economic calendar. Remember, the Fed look at core, they're expecting it to edge up to 1.8 from 1.7. Now, that's good news. It's closer to the 2% target of the Fed. So as long as inflation doesn't fall back, if it comes in below expectations, below, say, 1.7, that could just make markets just a little bit more wary of the Fed actually starting tapering. So we could see some weakness in yields, or a drop in yields, some weakness in the dollar as well. So watch out for that one. I'm going to take a quick look at euro as well, because we just had some better than expected ZEW data. And as you can see, we moved higher, broke back above that 133.60 level. Market managed to ignore what was coming out from an ECB member, Leikkanen. He is the head of the Bank of Finland. Actually, funny enough, the ECB seems to have their forward guidance down to a bit of a fine art, really, because he's been about maybe the third or fourth ECB member to turn around and say that interest rates are going to remain at present or lower levels for the near term. So even though it's not precise, it at least rules out the prospect of rate hikes. So we don't quite know the timing, but right now we know kind of the market's saying, well, minimum 6 months. So sorry about that. So the ECB is able to kind of, the ECB isn't going to be tightening before anyone else, before the Bank of England or the US, And if they're saying they're not tightening for the long haul till say 2016 or say I think it's Q2 2015 for the first Fed rate hike, then it's unlikely the ECB is going to do that before them. So really the Fed and the Bank of England are doing some of the heavy lifting for the ECB yet again. The ECB is a clever central bank, don't forget that. But basically here as well, quite, nice trend higher in euro. Again, that really long, let me just zoom in on here quickly. Very long upper wick yesterday on the back of that news, but we couldn't quite make it to 34. That's worth looking at. Couldn't quite make it to 34. So there's a huge wave of selling interest at 134. Worth keeping your eye on. That could, obviously the market isn't willing, is willing to sell on any strength. So if we get moved back towards that kind of 133.95 level, that was the high from yesterday, and then get to kind of here, these highs from kind of 22nd of August, when we got to 134.20, we think that could be met with selling pressure. So probably one to kind of maybe, fade a stronger move back towards 134, even though we did get quite a nice push higher on the back of that ZEW survey. It was quite strong. Again, the market does like, that the market's been, the German data, this is September data, it suggests that investor confidence is picking up in Germany, and that's good news for the overall Eurozone, but it is just one country's worth of data. So, and we have got the Fed meeting tomorrow, so that's a key thing to watch. Now, obviously, I know I'm just focusing mostly on the majors, but the last thing I want to show you before I take a couple of questions is dollar index, really. Actually, I'm going to show you two more things. The dollar index, as you can see here, just still really in the doldrums. We just haven't been able to recover. Now, we fell through this 200-day moving average at 81.70 in the dollar index. That to me is quite an important one. Now, the dollar index may not be a bad thing to trade on the back of the Fed meeting either, or to look at on the back of the Fed meeting, sorry. The reason why is that it's the overall, it's the dollar versus its largest trading partners. So you get quite a pure view of dollar strength or weakness. And in that way, it can be quite a nice thing just to look at, just to trade, just to see what's going on. So as you can see here, 81, we dipped below 81 yesterday, but we really did attract some buyers. So trading in a very tight range. We get kind of what is perceived as a fairly hawkish Fed. That could get us back above that 81.70 level, which would signal kind of more broader based gains in the dollar against the dollar as well. Now, I also want to look at gold, and the reason why gold is very sensitive to Fed tapering. The way to look at it really is that when the Fed tapers, that should be good. When the Fed, buys assets, that should be good news for the gold price, largely because it can weigh on the dollar. It can also boost inflation fears. The second thing to point out is that obviously tapering, and when they're scaling back their borrowing, even if they are scaling back their asset purchases, even if they're just reducing the size of purchases they buy, can be considered to be quite negative gold. Now, there's been a few other things weighing on the gold price as well. There's been quite low inflation around the world. In the US, for example, in Europe as well. Obviously not the UK, but, elsewhere. And this disinflationary impulse can also be considered quite negative for gold. But as you can see, obviously we've got 1300 is the bottom, is capping the downside for now, with 1340 on the upside. That's the range that we think we could be in, 1340, and then we've got this 1351 level, which is the 100-day moving average. 1340 is the 50-day moving average. So the pink and green lines on this chart. We could be in fairly tight range, we think, into the Fed meeting. And obviously if the Fed does taper or is slightly more aggressive than expected, we could easily get below 1300, with 1270 being a fairly strong level of support there, back from the beginning of August, and then potentially all the way back down to pretty much the 1200 level. However, if they don't make any big announcement, then we could whipsaw and just really carry on in this range. We haven't managed to sustain gains above 1400, and we don't necessarily think we will. So it'd be quite interesting to see whether or not the market just reacts to this Fed meeting as, okay, fine, goes up and down and then goes back to its ranges until, economic data proves or makes it likely that the markets or that the Fed will go one way or the other. Interesting one. I also just want to show you a very quick chart on Treasury yields, because obviously Treasury yields are going to be, pretty significant. As we said, the market is probably priced in about 20 billion worth of tapering. which is probably what the Fed is going to announce. It's more going to be kind of what the market expects the Fed to do after today's meeting, maybe in the next 3 to 4 months. That's going to have the biggest impact on things like yields. Yields have backed away quite significantly from that 3% level. That 2.8 level is kind of capping the downside. As you can see, it has pulled away from 3%, but it's not been an absolute, it hasn't fallen off a cliff. It's still an uptrend. We've still got a series of higher lows. So the uptrend is still in place, but this is just a bit of a retraction. Obviously, if we were to get below this low here at 2.7, that would be quite a negative development. I think that also coincides with the 50-day moving average. It does indeed. 2.71. If we get below there, that's quite a negative. That suggests that maybe the Fed has just become all a bit more dovish of late. Obviously as well, the next Fed governor comes into play as well. If it's going to be someone dovish like Yellen, when she's confirmed, even though it's actually more than likely going to be more of the same from the Fed, but it's just that initial knee-jerk reaction could just be for kind of lower treasury yields. But we don't think that Obama's going to announce that, certainly not this week anyway. That could be next week's worries. So I'm happy to take, I know I've gone a little bit over time, but I'm happy to take a couple of questions if you've got them. I'll take them first come, first served basis. If anyone wants to see anything about another pair. Of course you may not. Am I bullish or bearish? Pan, I always think the best thing to do in the lead up to a Fed meeting or any type of event of this significance is to be neutral. I'm willing to go with the flow, as someone said earlier, because I don't have an inside knowledge of what the Fed is going to do. Their communication, as I mentioned, is going to be very, very tough, incredibly difficult, incredibly difficult thing to work out. It's going to be really, it's going to be, it's going to be difficult. I don't have my ear to the Fed. I think they're going to have to deliver a very difficult message. And again, as I said, I wouldn't be surprised if the message ends up being market neutral, and just kind of leaves us back to square one. And then we're looking at the next event, which will be the September payrolls. It will be the next Fed speak, the next, speech from a Fed member. And we have got some Fed members speaking on Friday, so their speeches are going to be really important to determine, what's going to happen post this September meeting. I took diplomatic answer there, but any other questions? Cool. Well, I think that's it. Thanks so much for joining. It was really good to hear from you always. You had great questions. Really great to hear your views. Good luck with the Fed meeting. I'm really looking forward to next week because, we can discuss what happened and what their outcome is, and then to see, which way the market is going. Right now, it's just that kind of trepidation phase, where we're kind of trading in very tight ranges. There's also German elections this weekend, Peter, indeed. We think that a win for Merkel could give a bit of a relief rally to the euro. But do watch out if Merkel's FDP party, so the one of her coalition partners, doesn't quite make it, doesn't quite get enough votes to join the coalition, then there could be bad news for the euro, because it may mean that Merkel has to go into a grand coalition with the opposition Social Democrats led by an arch rival of hers. And if that happens, it didn't work when they tried to do a grand coalition in 2009. So that could be quite negative. So that could just kind of fuel some fears. Remember, Germany's been a massively stabilizing influence, or a very large stabilizing influence for the Eurozone currency bloc this week. In recent years. What with was during the sovereign debt crisis. If they're politically unstable, then that's not going to be good news for anyone, and we could see another huge flare-up of problems. But if Merkel gets through and her coalition wins her as the top, then that's a key thing. So Bavaria is conquered, so no worries, Rocco. Indeed it is, but it's that FDP is not, if Merkel on her own, she'd win hands down, I've no doubt about it. But it's that FDP that I think is the outlier. So again, likelihood is that Merkel will come into power. The outlying risk is that the FDP don't make it. She has to do a grand coalition, and that becomes a bit harder, and the market just freaks out a little bit. So yes, we've got German elections as well. Thanks for the reminder. But thanks everyone for joining. Great to hear from you as always. And I will look forward to joining you next week. Okay, everyone. Bye bye.